It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, the man himself, the smartest guy in the room, Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good. Ready to open up Christmas gifts here shortly and ring in 2021.
It is absolutely right around the corner, and be spending some time with my family like I have not spent the last 9 months with my family.
But what else is new, right?
A little bit of more that's just going to keep going on. Hopefully at some period of time that they'll release us back into the wild, and we can continue on our lives and see how that is. And you guys just closed another transaction. Tell us a little bit about that one.
Yeah, I kind of went to hibernation there for a little while and came out hungry, and a pretty good finish to the end of the year. Just closed on a 316 unit Class A deal over in suburban Fort Worth in a city called North Richland Hills. So pretty excited about that deal. It was our first equity raise kind of post COVID, and was a little unsure how it was going to be. And I was pleasantly surprised that this seems to be still a tremendous amount of interest and demand and the investor pool to go out and put money into the multifamily space in Texas.
I mean, you guys have done a great job of raising capital. I mean, you've had other, some great opportunities for people to invest in, and again, past performance is no indication on future returns. But how are you finding the investor pool these days? And a lot of people that are getting into multifamily, I would say 70% just want to be limited partners, and 30% want to be general partners, and kind of they want to be the Michael Becker in the future. But how are you finding going out and finding investors?
Yeah, it's very very well received. I think looking in the greater investment space, Paul, it's a world of bad options right now. Where do you put your money? The world's awash with capital. They keep printing more and more money and throwing it out into the financial system. So seemingly everyone has cash and no one has any place to put it. So you got your money, you put it in, your checking account or a CD, and in a CD, you're lucky to get, 0.5%, maybe 75 basis points a yield on a CD, or you can go into the stock market, which is continually being at all-time record highs, and valuations are stretched, or the bond markets, the yields are extremely low. So I think getting into hard assets with tax advantages and a market like Texas, or markets like Texas, or some of the Sun Belt markets in particular. And Texas isn't the only good market out there, but seeing all this migration that kind of started a couple of decades ago, coming out of the higher regulated, higher tax locations into Florida, Texas, Arizona, North Carolina, places like that. I mean, really seeing kind of exacerbated the trends that already happened are just accelerating. Really, and we're just seeing corporate relo after corporate relo, which we've been seeing for a long time. But it seems like we're seeing more and more of those in the newspaper, Paul, what I'm observing. And I think everyone else is trying to get the hell out of California and New York and take their capital and put it into places like Dallas-Fort Worth, where we bought a couple of buildings here recently. So just seeing the demand, and then just within the kind of just your general high net worth investor pool, kind of your typical syndicator pool where we all go raise money from. I think those people are very nervous about keeping the money in the stock market, and they're looking for something with a little bit more predictable, stable returns, and trying to get in these last kind of finishing 2020, get the last for sure known tax benefits that you're going to have. So we kind of locked those in while we could. I guess we'll see what happens in 2021 with any sort of changes in tax code, or if that changes the sentiment of the investor pool, that they're a little bit less worried. But that's certainly been a big economic driver, or big investment decision driver to invest in these types of deals that we put together, Paul.
Now, I guess you guys just closed on this large 300 plus unit property over North Richland Hills, but did I see you guys on the front page of the paper, the Dallas Morning News, last week or the week before? What was that all about?
Yeah, we bought another deal with some 1031 money. It's called 5 Mockingbirds. It's one of the more recognizable deals in all of town. It used to have all these beautiful Art Deco style murals on it, and it's on a major thoroughfare pretty close to SMU. And the prior owner painted over it when they did the renovation. So I think they kind of upset the entire East Dallas community when they did it. So I've kind of written a check with my mouth. We'll see if my buck can cash about installing some new murals and kind of bringing the old glory back to the Five Mockingbird apartments. So that got some pretty decent attention. So we'll see how well we actually execute. I'm pretty sure no matter what I put up there, I'm probably going to upset somebody along the way.
How big of a property was that?
About 450 units. So it was a pretty large transaction. It was the largest one we've done to date. So it was pretty exciting, and it's certainly the most high profile deal we've done to date. I mean, I was kind of talking with you and some other people, maybe one or two other apartment buildings I can think of that I probably would say is as high profile as this deal. So pretty big feather in the cap. I was real excited to get that done, and kind of reflecting back to 8 or so years ago when we bought our first crappy deal in Garland to how far we've come. It's pretty cool to kind of see where we started to where we are now.
Well, we asked Michael Becker because Michael Becker is the smartest guy in the room when it comes to operating apartment buildings. I mean, his group over at SPI, they have bought over 10,000 apartment units. As you know, Michael is a former banker for one of the largest commercial banks in the country. And so we kind of use his experience as a banker on the conservative side and an operator, or the guy who actually is doing it, and try to help you kind of understand a little bit about what's going on. So we come to Michael for the answers to the questions. Here's one that I thought was interesting that came in last week. Michael, I certainly do enjoy listening to the podcast, but I made a mistake. I went under contract and put $200,000 down before I showed this transaction to a lender. Now I'm scrambling to figure out how to finance this deal because the lender I showed it to that I thought was going to be the lender is not going to do it. Any suggestions on how to get myself out of this $200,000 hole?
Yeah, better call Paul, right?
I do that for self-serving, but a lot of people that I thought was interesting. A lot of people think they know the rules of the road, and that they will go forward and put money into these transactions and push the money over to the seller before they actually have a lender take a look at it. And I'm sure you've never done that, Michael, but
no, yeah, that's it's always your biggest partner in these deals, as we said many times on the show, is your lender's your largest partner in these deals. They're giving you 70-75% of the money to buy this deal, and your equities 25% of the money. So making sure you have that kind of all lined up before you do it, that is certainly a big no to kind of do that backwards. So that's that's a real problem. I would certainly, not to plug you too much, but certainly get with you or one of your guys, Paul, and start talking about options. You need some professional help. This isn't, especially when you're starting out, this isn't a business you kind of do on your own. You need to rely on your professional vendors. You don't practice law on your own, so you should, if you don't have a banking background or a lot of experience, I mean, that's how you make a living, Paul, is make sure that you can bring the right execution in, improve upon the debt terms, as well as, just almost increasing the likelihood of the certainty of execution of the actual loan itself. Because if it doesn't matter if you're paying an extra 50 basis points on your rate, if you can't get the loan, it doesn't matter because you can't do the deal in the first place. So I would certainly reach out to get some professional help and kind of triage the situation and see what you can do to bring in some alternative lenders. If a lot of people, if they're kind of growing up and coming out of single family or smaller multifamily, trying to do a larger deal, maybe they think they can just go to their local bank and they'll do it. But all local banks and regional banks aren't equal. They all have different rules and credit policies and appetites, and certain banks just don't like multifamily lending, and that's just nothing you could do. We'll get them to like it. So you need to go to one that does, and having someone kind of guide you to that as a resource, I think, would be really the thing I would recommend to reach out and get some professional help.
Yeah, you guys are looking at another transaction, what you've told me before we got on the podcast here, and you were telling me that you met a lender out at the property yesterday. Is that typical what happens before you guys go live on a contract? I mean, actually put money into the deal. Not only do you talk with somebody, do you try to bring them out to the property, let them see it, let them kick the tires a little bit, look them in the eye and kind of figure out, are you going to leave me at the altar without having a bride here? Tell me a little bit about what, at your level of the game, or actually the beginning in the game, at what period of time do you continue to do what you're doing?
I mean, with most of the stuff we've done for the last several years, really, we've done a lot of agency financing. So Fannie, Freddie, we've done a lot of the Freddie floater. I know you had your banker Trevor on a recent episode, and I thought he did a pretty good job of articulating it because I listened to that episode. And I don't know if they necessarily get on site, Paul, as much early on when we're doing like an agency loan, but we're certainly talking to them, well before we get into even agree to buy the deal. We're making sure we have a pretty good sense of what it's going to underwrite to. I mean, we're pretty close because we done this a few times. So we're pretty close at estimating what loan proceeds, a rate, and stuff are going to be. But before we ever get, agree to tell the seller that we're going to, do the deal 100%, we always make sure that we have the debt handled out. What happened here? We're buying a deal that's a little less stabilized than what we typically buy. It's in the 80s from an occupancy standpoint. It's in pretty good physical shape. Just having some operational management issues. And so we're a little bit nervous about putting a Freddie Mac loan on this particular deal. So I think we're going to go bridge. So we got a term sheet with numerous bank options from various bridge lenders, which is starting to come back now that as we're going in 2021. Those guys were certainly, the vast majority of those guys were just out of business up until a month or two ago. Paul, is kind of when we start seeing some of the bridge lenders really start coming back.
That's correct.
Yeah, we had a confidence why we haven't actually, we got into escrow. We don't have the specific lender we're going to use on this transaction nailed down. We had a term sheet that was, close enough from, half a dozen lenders that all were within, reasonable shot of what the economics we were looking for and the loan proceeds we were looking for. So we felt pretty confident we can get her done at the end of the day. But yeah, I toured one of them out there. I'm probably going to tour another one out there Monday or Tuesday, and then try to pick a horse a week after we got into escrow. But we had upwards of 90 days, so we felt like we had plenty of time to kind of get it done. And we're starting to see, these bridge lenders starting to get a little bit more aggressive because spreads really widened out quite a bit and just really didn't make it very attractive, especially relative to Freddie Mac. I mean, the Freddie Mac stuff is really hard to beat from a pricing standpoint, but I'm starting to see for a deal of some size, and obviously we have a pretty good track record, and we're buying in the submarket that we've owned multiple other assets, including a property right across the street from the property we're buying. We're starting to see stuff kind of getting that mid to high threes, Paul, at 75 leverage, and
that's a big transaction. So.
What's that?
Yeah, that's a big transaction. So usually on these smaller transactions, when it's $5 to $10 million, it's going to probably be right around 4% or so on some of these bridge loans. When you start to go up to higher levels, then it becomes kind of a negotiated rate. Did you go directly to the bank or to the bridge lender, or did you go through, without naming the names here because you didn't use Old Capital on this one, but did you go through a broker?
Yeah, both. So we have some relationships that we banked with in the past that we have a couple term sheets, and then we had someone else kind of go to the marketplace because we wanted to get a little wider reach because we're just a little uncertain on exactly what the marketplace would bear today, because it's been a while since we did a bridge loan, Paul, and the marketplace was there's basically no bridge debt out there for several months there. The spigot got completely turned off in mid-March and started turning back on a little bit, 2-3 months ago, probably. You probably know better than I do. 2-3 months ago when we started seeing some of those guys come back into the marketplace. And then, for us, it's not just about the economics of the deal. For me, it's really about certainty of executions right there with it, because I'm going to stick my neck out. We're going to do all this. I don't want to go 4 weeks into a transaction and get dropped in the grease and have to scramble and start over right when we got a closing deadline on us. So these bridge lenders aren't created equal. So a lot of the guys that had the biggest problems here, 6 or 8 months ago now, really are some of these debt funds that had a CLO line. So they had they go get basically a warehouse line where they have some capital, but then they get a bank that they're gonna say, I buy a property and make me a loan at 80% of my costs, and they'll go securitize that paper with another bank that maybe loans them 75% of that. So really, that warehouse lender has maybe 50% of the underlying real estate value. So they kind of lay off a good chunk of it so they can just, borrow some money at lower rates and lend it out at a higher rate and kind of scalp a spread on the bulk of the debt. So those guys are a little bit riskier from a borrower standpoint versus like someone that's loaning on their own balance sheet. So like a lot of these life cos have balance sheets where they do, permanent debt that you kind of think of, 10-year fixed rate money, like you think of life cos, as well as they have these bridge debt platforms where they'll charge a little higher spread, take a little bit more risk, and they'll go out and do these bridge platforms. And there's numerous regional and community banks out there as well. So kind of understanding who your counterparty in this transaction is on the lender side is really important, because all bridge lenders aren't created equal, and you're a little bit more likely to get in trouble if you're going to somebody like a debt fund that might have to lay off a piece of this to a warehouse line, because if the warehouse line gets yanked on them, they're just out of business, and you're stuck in the middle on collateral damage. And we had a deal we were selling in March that blew up because the buyer of it had that exact scenario happen to them, and it kind of trickled down to me as a seller, and their problem became my problem real quick.
Not good. Michael, how do people get as smart as you? Is it videos? Is it books? How did you get so smart?
I certainly have my 10,000 hours in. So we worked in the business as a banker for a really long time, and then just have done a bunch of deals. So I've kind of seen a bunch of it, but I think listening to podcasts like the Old Capital podcast, like everyone who's listening to my voice right now is doing, is certainly a good way, networking. And one of the things that maybe a good segue, Paul, is one of the things that we're going to try to do to kind of supplement the Old Capital podcast, which we'll announce a little bit more formally, but we'll kind of give a little sneak peek here. I just launched a new show. It's actually on video. We'll also release it on iTunes and Stitcher and audio format as well. But going to be in the studio and trying to interview some people that are a little bit more seasoned and experienced in this business, and maybe kind of take this from a standpoint of, stuff that's kind of interesting to me is listening to people and kind of that have done, not just, one or two transactions, but, billions and billions of dollars of transactions. And how do you scale up? So, brokers, economists, other large apartment owners in the space. So started a new show. It's called the Multifamily Investing Show with Michael Becker. So I know a real original show name there, Paul.
It'll be carried on the Old Capital Network.
Yeah, the Old Capital Network. But you find that on iTunes or Stitcher or YouTube. Started a Facebook page. Our website is themultifamilyinvestingshow.com. So it's multifamilyinvestingshow.com. You can go there and subscribe to it. So certainly, if you guys like this podcast, I would certainly appreciate it if you go to our website or go to one of the platforms, either YouTube or one of the podcast platforms, and follow us, subscribe, give us a like. I'd certainly appreciate it. We have a couple episodes just launched. We're going to launch them at noon Central Time on Wednesday. So hopefully I can keep up with all that, because we've got to do them in person. So a little bit more logistically challenging than what we do today. So hopefully I can keep that up and put out some pretty good content, and hopefully we'll replay maybe an episode or two on the Old Capital podcast to kind of give a little bit of flavor for everybody.
I've gotten a sneak peek of it, and it is fantastic. So go on to the Old Capital podcast, and we will give you the website. Again, if you want to go into that would certainly be great for Michael and his new show. Again, it's a YouTube show, so you'll be able to see Michael, what he looks like, and all those guests too. So, Michael, certainly do appreciate you coming on. And before we go, tell me again a little bit about what SPI does.
Yep. Our main focus going into 2021, Paul, is really just putting together high quality opportunities and putting it out to the database and raising some money. So if you guys want to find out more information about what we do, besides the new show URL, again, was the multifamilyinvestingshow.com. You go there, or you go to my company's website, which is SPI Advisory. So just simply go to www.spiadvisory.com. There's a contact us form. Fill that out, and we'll send you out some information and get you added into our database and put future opportunities in front of you as they come. So we're hopeful we'll have one out here in Q1 actually. So we're kind of working on putting a deal together right now.
Sounds great. Thanks for your time, Michael. Certainly do appreciate it. Again, Michael Becker with SPI. I'm Paul Peebles. Have a great day.